Assalamu alaikum, everyone. We are here with the day 19th of Startup Summer School. Apparently, this is the second last day of our program, but how we see it, that it's not the end, it's the beginning of an era. So let me give you a quick recap of what we've been through. We started with leadership, then we moved to product development, where we covered design thinking and business model canvas. Then we moved to managing your startup, where we covered marketing, sales, negotiation, and legal. Today, we'll be covering how to pitch to an investor, how to seek investment. We've got Arooj Sheikh with us from USA. And what makes this session very interesting is that she is an entrepreneur turned VC. So she knows both sides of the table. And another thing which makes this session very interesting is that we have got two VCs with us, a vice chancellor and a venture capitalist. So, so over to you, Arush. Please begin. And also, please start with your journey. How come you transitioned from an entrepreneur to a VC?
Yeah, absolutely. Thank you so much for introducing me. I'm super, super excited to be here today. I'm myself a Pakistani American. I'm from Lahore. So very, very excited to give back to Pakistan's economy. I would absolutely love to see Pakistan to grow into the huge innovation economy that I know it can be. As for a little bit on my background, I started off as an entrepreneur and I kind of fell into venture capital through a series of events. Primarily, my passion was entrepreneurship. And I previously had started a real estate tech startup based in Austin, Texas. And then I started working with other, major players in the startup ecosystem. So I went from venture studios to startup accelerators. I've worked with one, I've been through one, and then I landed in venture capital. And the reason that I found it was a really great fit for me personally was because my passion was largely entrepreneurship itself. I love seeing people, come up with big ideas, create things that, initiate real change. My personal mission statement is to empower world-changing ideas. And so, venture capital and also the finance side of it, which I really enjoy, it just made sense for me.
Wow. That's very interesting. And now let's move to your presentation.
Sounds good. Let's dive right in. So
Yeah.
I will say, if you can grab a piece of paper and something to write with, that would be fantastic. We have a ton of material to go over, so I just want to make sure that you have access to this information later on. So take notes. All right, so let's dive right in. So here's my presentation. It's pitch deck prep and planning your raise. So here's what we're going to go ahead and cover initially. So we have our first part, which is pitch deck prep. We'll learn how to craft a compelling pitch for your company. What was that?
Arush, please continue. Sorry for the disruption.
No worries. In this section, we'll cover each of the major components that goes into your pitch deck. So, your problem, solution slide, all that good stuff. Next, we have planning your raise. So here, we're going to learn about your fundraising fundamentals to help you plan your raise. How to answer the question of, what stage am I fundraising at? How much money do I need? And that sort of stuff. So again, part one, pitch deck prep. So here we have the pitch deck. So a quick introduction to what that is. A pitch deck is the industry standard fundraising tool. It's often the first impression of your company, so it's really, really important to have a well-designed deck with a compelling company narrative to go with it. Generally, with earlier stage companies, you don't have the metrics that are screaming, invest in us just yet. So it's really, really important that you have a vision of where you want to go, where your company is right now, and the impact that your company could create one day. So here are some of the components of the pitch deck. So first, we'll start right off with the elevator pitch. So the elevator pitch is a 30-second introduction to your company. So, quick, this is what our company does. It's a very high-level introduction. It's meant to grab the attention of the audience. A great way to do that is usually through, breaking your company down to high-level concept. So, something like Uber for cats, so something of that sort, or emphasizing, we use AI to do XYZ. And that way you have something to grab their attention, you have a buzzword in there, and you have like a high level concept that's really easy to grasp. And that starts you off on a good note for the rest of the presentation. Next, we have the problem side. So with the problem side, we have, the problem that your product is solving. And the best way to do this is generally through a customer story. So what that means is that, if you have a customer, fantastic. If you don't have one yet, use a customer persona. And that's, a marketing trick that you can use. Look into creating buyer marketing personas and, craft a real person. So for example, say Bob forgets to, take his medicine every day, and he really needs to take his medicine. It's gonna hurt him in the long run if he doesn't. Something like that, and using a real person's name. Sometimes you can even throw in like a fake headshot or something of that sort. There's always, websites like Unsplash where you can get images and that sort of thing, and that helps bring your problem to life. And that's really, really important. You want your audience to feel what your customer is feeling, right? So make sure you distill the problem into 3 major pain points. Bob forgets to take his medicine. It's bad for his health, that sort of thing. And that makes it really, really easy for the investor to follow along as to what your problem statement is, what your company is solving. Another thing I want to briefly touch upon is the aspirin versus the vitamin problem. So, the way that you think about it, aspirin is like when you have a headache. You have a headache, you go to the store, you're like, I have this terrible headache. I just need something to make it go away. And that's an immediate problem versus the vitamin. The vitamin is like, this is good to have. It's, nice to have, but I don't have like a headache. So, think about it this way. If you have a headache and, you go to the store, you're going to pick up aspirin or you're going to pick up a vitamin? Chances are you're going to pick up the aspirin. So that's essentially the concept that we'll be using here for your problem slide. And this is a really good concept test to help you kind of determine how your product is positioned. Ideally, you want to be an aspirin problem, although of course there are a couple of ways that you can still frame a vitamin problem to still make it seem achievable and a good problem to solve. But the more immediate, generally the better. Next up, we have our solution slide. So once your audience feels that pain, they're like, oh, I totally understand where Bob is coming from. I forget to take my medicine too sometimes. Once your audience feels that pain, hit them with an introduction to your product. How does your product solve that problem? We send reminders to Bob every single day to take his medicine at 9 a.m. in the morning so he doesn't forget, first thing in the morning. And that's a really great way to make sure that you're matching up with the features of your product with your problem. Make sure you make that connection, because sometimes people can just, dive right into their product and they're like, hey, yeah, I'm a product person. I like to code, or I am like a medical person who's creating this drug, something of that sort. And they forget to, really tie their solution, their product back into their problem. So that's really important. And also, again, some people have a tendency to just create a product and then try to fit their product around the problem. Fit their problem around the product. And what you really should be doing is you should be fitting the solution to the product. So make sure that each problem statement, each problem major pain point that you're addressing is solved through a feature of your product, and make sure to make that connection. Next, we have market sizing. So this is where you want to quantify the size of your problem. So once you've had the investor, you have their attention, and they're clearly interested, like, oh, I completely understand. I feel for Bob. And then you want to hit them with, this is the size of the market. We have XYZ validation. That can mean traction, that can mean user interviews, whatever validation you have, this is where you want to put that information. You also want to include sizing. So, 1 million people every single day feel this problem. 100 million people, 1 billion people around the world, something of that sort. And then you want to focus on timing. Why now, right? So, right now people are busier than ever. They always just, are in a rush to get out, go somewhere, although not right now, but usually. And so that sort of thing. And then next we have the opportunity. So really focusing on what the market opportunity is. So instead of just focusing on where the market is right now, your product should be something that's disruptive. So you should be creating a new part of the market instead of just saying we're going to capture 1% of the market share, which is fine for like a small business, but for a startup that's innovative and disruptive, you want to focus on creating a whole new market altogether, kind of like Uber. Next up, we have our competitive analysis. So talk a little bit about who your competitors are and why are you different from them. This is an area in which investors will do a ton of due diligence to make sure that you are the best strategic play in this space. Many investors and venture capital firms will generally focus in on a couple of verticals. So for example, say that Angela is an investor, right? And Angela focuses on SaaS products, consumer products, and those are the two areas that she invests in. So generally, she's going to have a pretty decent amount of industry expertise. And sometimes investors will end up investing in competing products and services because say that you are starting an electric car company, right? So you have your electric car company. That investor maybe is invested in 1 or 2 other electric car companies, and that sort of just helps you understand like why should you be one of the plays. If they know that if this investor is making a prediction that everyone's going to have electric cars by 2030. So that's another big thing, and that really comes down to also knowing who your investor is, who you're talking to, and also just knowing your market. Next up, we have our unique value proposition. So for this, you don't necessarily need a whole slide dedicated to it, but it's important that you get this point across. What sets you apart from everyone else? And more importantly, how defensible is your competitive advantage? If you are a CPG product, consumer packaged goods, in that case, you need to go a little bit beyond just the branding of your product, right? So the branding is as strong as it can be sometimes. You want to make sure that not like a bigger competitor can come in and just copy your product and then sell it because they already have that brand built. Intellectual property, having a patent, copyright, trademarks, that sort of information, or some really, really cool tech with very specific industry expertise, something of that sort, to really set you apart and make sure that once you start gaining that traction, you can have a way to maintain it, which is even more difficult than just getting the traction, which is, just marketing. So next slide. So now we have our second half of the pitch deck components. So here, number 7 is go-to-market / traction. So here you're going to want to share your relevant industry metrics around traction to show what milestones you've achieved and where you're headed next. Let me emphasize that again, where you're headed next. So a really great strategy for this is to use data visualization to kind of, point the way forward, like we're going in this direction, and that's just a really good rule of thumb to kind of show what your potential is. And that's the really important thing. That's what investors are looking for in the world of startups. How far can you grow and how fast can you grow? And then also, if you have any metrics showing the stickiness of your product, so anything about, if you have a SaaS product, how often, how many times does your user open the app? Something of that sort. Have 20% of your customers referred other customers? That's a big deal. Making sure that you have that information available to you and that you're sharing those key points with your investors. That's hugely attention grabbing. It shows that your product is, something special. Definitely sets you apart. And then also using social proof. So for example, customer and user reviews, if you have press, if you've gotten any awards, that sort of thing, if you have it, this just adds to your credibility altogether. The the best thing that you can say in your presentation is, of course, you're going to have to sell your own company, right? But having someone else sell your company for you, that's different altogether. And that leads us to number 8, which is the revenue/business model. And this is pretty straightforward of a question. How do you make money? Do you have a subscription service? Is it a one-time cost? Is there something that you're expecting to increase the lifetime value of your customer? And it's really, really important to make sure that you have this down, because in general, and I'll get to this in slide number 10, which is metrics and financial information, but projections, all of them are wrong. All projections are wrong. If by some miracle you can, create some accurate projections, you should not be in startups or venture capital. You should be, a billionaire already, if someone could predict the future. So again, yeah, revenue and business model, making sure that you have that information on what your unit economics look like. That's the most important aspect. Next, we have timelining and exit strategy. So understanding what major milestones will your company need to hit before an exit. So this doesn't necessarily mean that you have to timeline everything. It just means that, for the next 3 to 5 years or so, you need to have an idea of where your company should be and what that success looks like at the 1-year mark, at the 18th month mark, at the 3-year mark, that sort of thing. And, investors in venture capital, they're aiming for a 10x return. So if they invest, $1,000, they're going to expect $10,000 in a return. So understanding the dynamics of, what your exit strategy could look like is really important, and we'll get into that later in the presentation. Next up, we have metrics and financial information. So here we're going to be sharing key attention-grabbing metrics related to your business. So, revenue, revenue to date, revenue growth, that sort of thing. And again, you want to focus on the unit economics of your company, because all projections are just that, projections. Investors know that's not actually what you're going to be achieving. It's important for you to have them just so that, you've shown that you've done the work, you've thought about it a little bit more in depth. But, chances are that's not going to be realistic. And for projections, another tip is that, you want to have information available. You don't need to throw it out there right off the bat, but, worst case scenario, most probable scenario, and best case scenario. So having those 3 ranges so that, investors can have an idea of what could be the potential outcomes is really important to have. It also helps them understand the risks that they're taking by investing capital into your company. And, one of the most important things, especially for early stage companies, and, I say this, a ton of investors say this, is that when you're investing in early stage companies, you're not actually investing in the company. You're investing in the team. And this is really, really important to emphasize because, in an early stage startup, you don't yet have those metrics. Chances are you're still in the idea stage. So it really comes down to, showing that your team has the expertise to start this company and that they have a proven track record of being able to execute on the things that they say they're going to execute on. So for example, if you have industry expertise, if you've been in medicine for 15 years and you're starting a healthcare company, say that, share that information. Or if you are, if you and your co-founder have complementary skill sets, like you are a business co-founder and then your other co-founder is technical, making sure that you can share those bits of information about complementary skill sets. Know where your weaknesses are and make sure you fill them in with people that are really, really good in those areas. Hire people better than you. Best advice that I can ever give for a company. Next, we have our CTA and appendix. So have a clear call to action. CTA is call to action. So with a pitch deck, your goal is not to get an immediate investment. No one's going to invest in you the first time they talk with you. As much as I wish we could, it's just not the way that it works. We want to have follow-on conversations. And the entire point of the pitch deck is to pique an investor's interest, to get that follow-on meeting. You want to start those conversations about a potential investment. A lot of the times it can be as simple as, hey, I would love, 15 minutes of your time to hear back on my pitch deck. I would love to hear your thoughts. Something of that sort. Make sure you have something clear and concise, something small that you can ask for, 15 minutes on the calendar to get started. And then also, as for the appendix, that's pretty much just, I wouldn't send the appendix via email, but if you're presenting live your pitch, it's really helpful for Q&A, because investors, they like to tear down your pitch decks a little bit. I certainly enjoy it. And so it's definitely really great to be able to have a visual about any potential questions that you have. And the more that you pitch your company, the same kinds of questions that you keep on getting, and you can incorporate that into your appendix later on. So here we have a couple of things of, really important strategies that I recommend using when it comes to developing your pitch deck. So the first is to incorporate storytelling. So storytelling is the secret sauce that makes your pitch memorable. So in your pitch, there are two really important ways that you can use storytelling. So the first is to, explain your problems and solution slides. So again, kind of on the notion of that customer story, having that customer to show and say, Bob, I totally understand, make them feel that connection, make them feel that problem and how important it is to solve it and why your product is the best, solution for that. Again, you can also use a founder story. So for example, if you yourself experienced that very problem, that's how you came up with the idea for the company, share that information. It can be very compelling to hear a founder, solve a problem that they themselves were personally experiencing. And it also makes you, as the founder, all the more qualified to start the company that you're starting. Next, we also have, using data and metrics to paint a story of where a company is headed. So painting a vision of what success could look like, having that, imagination aspect, getting your investor excited about where your company can go is super, super important. And not only will it help you get an investment, it will also help you get an advocate for your company. So, a lot of VCs will just invest in your company, get your quarterly updates and that sort of thing, and they're pretty passive sometimes. You want your investor to build a relationship with you. You want them to be making intros for you. You want them to help sometimes give you feedback. So getting them to care about your company is really, really important, and it'll go a long, long way. You never know. They might be the ones introducing you to your next investors. So really, really crucial part to play with storytelling. Definitely goes a lot, way, way further than just getting a VC investment and funding into your company, right? So very, very important. Next up, we have persuasive pitching. So psychology can play into pitching in a lot of different ways, namely persuasion. So here are just a couple of high-level ways that you can include this information into your pitch deck to help sort of speed along the process of getting them interested. So one is social proof. I talked a little bit about this earlier. So you're going to want to list any partnerships that you have. If you have a partnership with Google, by all means, that is something that you should absolutely include in your pitch deck. If you have an award or you've been recognized by something like TechCrunch or whatever, something of that sort, or publication, absolutely include that information. If you or your team members were previously working at Facebook or Google or Apple or something of that sort, or a big well-known company, include that information in your team slide. That just makes it all the more compelling. The more credibility you can give your company, the better, because you're the one that's selling your company. These are also bigger names that your investor might be familiar with. It's not to say that you need these, but it doesn't hurt to have them. Next, we have scarcity. So creating that sense of urgency with market opportunity. Why now? For example, investing in Zoom. If you had bought stock in Zoom, a couple months back, that would have been a really great time to do that. because people are getting online, they're spending a lot of their time, energy, and effort, resources online. That's our main way for social communication nowadays. So absolutely important to emphasize why now. You do want to be a little bit careful with this, is because a lot of founders can come off as a little bit arrogant, and investors tend to find that as a turnoff. So be very, very confident and excited about your company, but don't make it sound to where like you're missing out. Like, don't miss out. Like, create that subtle sense of urgency, and don't outwardly say like, hey, like you're gonna miss this, but make them feel it, and that's different. And that goes a lot further. Next, you also have, with your CTA, when you're asking for that CTA, that little call to action, that can be something as simple as like a follow-on meeting, right? Get that in the calendar, or, cite a reason. Say something like, I would love to schedule this upcoming meeting with you because I think that we would work really well together. Cite a reason, any reason. Doesn't have to be a great one. It could be, it should be, but having a reason psychologically just tends to have people comply with the request a little bit better. So it's just good to have, to like throw that in there. And asking for a small commitment, like an introduction or something of that sort, can go a long way. And having those little like those little warm, small little asks can often lead up to that investment. Asking for like $1 million right off the bat, the first time you're meeting someone, it's definitely a bit of a big commitment. So you want them to bite off little chunks when you can. Next, we have design. So design can be used to emphasize the most important pieces of information in your pitch. So if there's like a key metric that you're really proud of, like make it bold, like make it shine in your presentation. There's also the rule of 3, which is, people remember pieces of information best when they are, shared in 3 key points. Again, distilling your pain point, distilling your problem into 3 main problem points, that sort of thing. It just makes it easier to remember and recall. Next, we have the 10, 20, 30 rule. 10 slides, no more than 20 minutes, and 30-point font or larger, just so that your slides aren't too text heavy. So next, we have planning your raise, and these are just fundraising fundamentals to help you plan your raise. Just give me a second. Let me drink some water. Okay, so let's dive right in. So here is, what type of investor is right for you. So there are definitely a couple of different types of investors that are out there. Figuring out who is the right investor for you. There are a couple of different, strategies to think about that. So angel investors, for example, these are high net worth individuals that invest in startups. Usually they're startup veterans, so a lot of the times they'll have they'll have started a company in your industry previously, and it's investing is their way of paying it forward. They tend to invest in early stage companies. They like to be involved in the companies a little bit more frequently, so they'll often be meeting with you, as much as once a week. And that's really, really great to have an angel investor with a previous exit in your industry, or previous industry experience with whatever your company is doing. So early stage investors, usually they invest in pre-seed companies, which we'll get into the stages of fundraising in a bit. Next, we have family offices. So generally, family offices are tougher to target. It's only really if you have those types of connections available to you, which, family office is privately held office that handles investment management for a wealthy wealthy family, where generally their assets are over $100 million. These are, multimillionaires, billionaires, that sort of thing, that like to, dabble in investments in VC and that sort of thing. It doesn't happen too often, but if you have those connections, it absolutely is something that's available as an option. Next, we have venture capital firms. Yay! So a venture capital firm invests in high-risk, high-reward companies that are innovative in their industries. So these firms are looking for 10x returns on their investment and are most frequently targeted by startups fundraising. And that's largely because venture capital firms, they have a certain amount of checks that they have to write. They have a fiduciary duty to write those checks. Angel investors, if you can build a relationship with them, fantastic. But it really depends on what their financial standing is, and there's just no real way for you to know that without outright asking. So generally, venture capital firms are a really safe way to go for fundraising. Next, we also have equity crowdfunding. So equity crowdfunding is definitely a little bit of a newer method of fundraising. Essentially, it's kind of like an IPO, but not really. It allows you to, it allows a private company to sell shares to the public without being listed on a stock exchange like the New York Stock Exchange. So, for example, say that you start a bakery, you sell shares of your company, and you're not publicly listed. So essentially it's just as simple as that. So here I'm going to talk a little bit about the two main types of exit strategy. And this is just more so that, for later reference, it makes sense when I am using these terms, kind of just cluing you guys in on the terminology and whatnot. So first we have our acquisition. Most successful exits are via acquisition. And that is really, really important to remember when you're doing your exit strategy planning. So an acquisition is simply described as, a large company purchasing a startup. So acquirers will often be customers of your product or competitors of the startup. So, for example, a good way to think about it is if you have, an app that you created and Google is creating an app that's very similar to what you're creating. A competitor of Google might want to purchase your app so that they have a fast entry into the market without having to do all the initial legwork themselves. And that's just like a play that they can make in the market. And that's a really great way to think about how an acquisition works. So it's definitely important to have a good understanding of what your industry trends are and how you could potentially play in that in the long run. And then we also have IPOs, and these are the unicorns. Unfortunately, they're unicorns for a reason, because there are only 150 to 200 companies that IPO every single year. So IPO stands for Initial Public Offering. Essentially, it means that the company's securities or shares are offered on a public exchange like the New York Stock Exchange to be publicly traded. So apps like Robinhood, you'd be able to buy and sell shares. Is essentially all that means. Essentially, what it does for the company is it's a tool to raise a significant amount of capital. So if you are, acquiring other companies, if you're rapidly expanding to another country, continent, market, it helps you get the capital you need to do that rapid expansion. And then also it offers liquidity to founders and investors. And that's a huge, huge thing. And that's sort of where, the IPO comes in. Next, we have our stages of funding. So here we have pre-seed companies. And pre-seed companies generally raise $50,000 to $200,000. Funding is generally used to get operations off the ground, as the company tends to be pre-product. Essentially, it's in the idea phase. Many companies will skip this round of funding. And actually, just a quick note on that. Not all companies will go through all of these funding rounds listed here. So for example, sometimes a company will bootstrap all the way to their Series A. Fantastic. That means that they have enough revenue going for them to have been able to grow to that point, and that's where they need that capital injection so that they can scale faster or something of that sort. So this by no means is a set rule of thumb or what stages a company has to go through. It's just pretty industry standard. And also, as for the ranges of how much money is raised through each stage, it varies greatly depending on where you're geographically located. So for example, if you're in Silicon Valley, check sizes just tend to be bigger. There's tons and tons of money flowing in and out of the valley. So valuations tend to be higher, check sizes tend to be higher, also because the cost of living is really high. So that's just another thing to note. Again, diving back into pre-seed, investors tend to be friends and family, angel investors, and micro venture capital firms. So, these are funds with less than $20 million in asset under asset management. Next, we have seed companies, and these are at this stage, you tend to be raising between anywhere from $100,000 all the way to $2 million. It's a big range. And funding is often used towards product development and jumpstarting early revenue generation. So at this stage, there tends to be a little bit of traction and early signs of product market fit. And that way you kind of have like a little bit of momentum going. And that's where angel investors and early stage venture capital firms will often invest. Next, we have our Series A. So that's $2 to $10 million. You have strong signs of product market fit, and fundraising is, funding is primarily used for hiring, setting up scalable marketing and sales systems. So you've kind of figured out what your product, like what works with your product, what doesn't work with your product, and now you're kind of just in that phase of growing your company. And of course, like these stages also vary from industry to industry. More capital-intensive industries like hardware companies or biotech will have raised a lot more money. And also, they're not necessarily have made as much progress on the products because they have longer product cycles for that sort of thing. So here again, we have our Series B, that's $10 to $50 million. And funding is again used to hire employees, expand into new markets, or experiment with a couple of different revenue streams. So if you have like another business unit that you want to start, this is a great stage to do that at. And generally at this point, you are officially in the late stage. So late stage venture capital firms will be investing in you. Also, quick note is that a lot of acquisitions tend to happen in the Series B and Series C stages, sometimes in Series A, and sometimes earlier as well, depending on if you have intellectual property or something of that sort. So it really just depends again on industry. So next we have Series C and beyond. So sometimes you can get all the way to like Series E, Series F. So it really just depends again on the industry that you're in. What kind of milestones you have for that company. And generally after Series C, you will go for an IPO, and that's to get liquidity. So Series C is anything above $50 million, and this funding fuels large-scale expansion. So often if you are expanding into an international market, this is a great round to raise. It's also useful for small acquisitions of other startups. And by this point, you have enough metrics and KPIs in your company and enough information for, private equity firms to join venture capital firms investing in the stage. Next, we have debt versus equity, and this is just a super brief overview. We have convertible debt, which convertible debt is debt. That's really important to emphasize. Convertible debt is debt. It's not going to show up in your cap table just yet. So convertible debt can convert to equity with an equity financing. So for example, what this means is that you can delay the conversation about figuring out where your valuation is. It's often used for early stage companies. Essentially, what happens is that an investor will give you a convertible debt note for $100,000 and say, okay, go build this company, and then when you raise your next round of financing, say you're raising $1 million, it's an equity round, that's when that convertible note will convert to equity. There are two really important terms to know here, and one is the interest rate and two is the valuation cap. So the interest rate is, again, convertible debt is debt, so it does accrue interest. You have that interest rate as well, and then also you have your valuation cap. So for the valuation cap, that means that, say that your equity round that you're raising is actually $2 million instead of $1. Congratulations, you have a high valuation. Dream for everybody, So the valuation cap, say that investor agreed, and you agreed that you would do a valuation cap of $1 million. So everyone else's equity, so essentially the round that it converts at, they'll be purchasing at the $2 million price for valuation, and then your previous investors' investment will convert at $1 million valuation. So essentially, they'll be getting more equity because they took more risk and were there earlier on in the company. Pretty standard, they took a lot more risk than later stage investors that have more information when they came around. So it's a nice way to, reward your investor for supporting you earlier on. You also have safe notes, which is a type of convertible debt. Safe note stands for simple agreement for future equity, and very similar to convertible debt, tends to be a little bit more founder friendly, popularized by, startup accelerators like Y Combinator, very, very prominent in Silicon Valley. And essentially just has no interest rate. And that's the major distinction between a safe note and a convertible debt note. Next, we have equity, and equity is a lot simpler to just kind of throw out there. So an equity round is simply an investor purchasing a specific percentage of your company at a set price. So here, you're going to have that negotiation on the valuation. Again, very simply, you sell X shares for X% of your company based on the valuation that you have, that you've set with your investor. And a lot of the times from the investor side, it's fantastic because they know exactly what they're getting when they put money into your company. Next, we have startup valuation. So this is a bit of a hidden discussion of price. So, convertible debt delays the valuation discussion, but when you set that valuation cap, it sets sort of an expectation of what, that investor is expecting your next round's valuation to look like. So, just want to keep that in mind. So, that's just like more of a negotiating thing. As for early stage valuation versus late stage, essentially that's just, late stage, you just have more information. So you're going to get more accurate picture of what your valuation looks like. Honestly, the best bet for understanding your valuation is whatever your investor is offering you. So there are a couple of tools like Equidam, which you can calculate your own valuation so you have a fair market value. But generally, again, it highly just depends on the valuation that you and your investor agree on. And there are a couple of things that you can negotiate with. If you have intellectual property, there are industry multiples. So if you have revenue, 10x your revenue, and that's the valuation of your company, for example. That's standard for like fintech, for example. You also have sweat equity. So if you say that you have like a very specialized skill set and you should be earning 100K at Google, for example. So instead you're working at this company, and that is something that's to be taken into account, showing that it's a very specific skill set, and that increases the valuation. Again, traction, that sort of thing, also is taken into account. So almost there, almost there. We have a ton of information to go through. I hope this has been helpful so far. We're very close. So a little bit of information on the U.S. venture capital fundraising process. So we have pitching. This is just, most founders will end up meeting with 30 to 50 investors to close a round. That's a lot of meetings. Exactly. That's, pretty standard. Your best bet is to get warm introductions. So have someone that they know introduce you. Best bet to actually get a response from the investor. Next, we have term sheets. A term sheet is just a non-binding document that summarizes the basic terms of a VC investment. So your best case scenario is to have multiple term sheet offers on the table, and that just gives you negotiating leverage when you are having those conversations. If you want to say no to one term sheet, you have the option of signing another one. That's super, super important. Best case scenario. And here you're going to be negotiating valuation and price, the terms and the term sheet. There is a no shop clause. So once you sign a term sheet, a lot of the times that means that you are unable to be shopping around with other term sheets. So make sure that once you get a term sheet, you have a couple of them at around the same time range so that you can negotiate amongst them. But once you sign one, you can't go looking for other VCs term sheets. And one thing that I really, 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 really want to emphasize is how you structure your terms impacts your exit. Now let me repeat that. How you structure your terms impacts your exit. So you want to be very careful with negotiating your valuation, your price, your liquidation preferences to make sure that when you have an exit, you can still walk out of it with money. There have been cases where, for example, founders have had a $50 million exit, which should be very successful. It looks very successful, but then they've walked away with $80,000 for 4 or 5 years of hard work that they put building that company. So this is really important to get right. Make sure you talk to other founders, get references, get help, make sure that the term sheets that you're looking at are fair, and all of that good stuff. So, finally, we have our due diligence and investment. So due diligence is just, kind of an evaluation of the investment opportunity. So it's different at every firm, but generally it'll also consist of, making sure that you have a Delaware C corporation. That's just because Delaware has very established case law and other paperwork. So if you have intellectual property, you want to make sure it's assigned to the company. Any employment paperwork, you have that all up to date. Technical or product due diligence. A lot of VCs that invest in a specific industry, so biotech, for example, will make sure that the product is actually feasible, is sound, something that you can actually do. And then also, investors will go for the preferred stock, and then founders go with common stock, and that's just pretty standard. And yeah, so next you have how much should you raise? Sorry, I'm trying to finish. Lots and lots of content to cover. So, how much should you raise? Well, it depends. So there are a couple different things that you should take into account. Are you in a capital intensive industry? Are you in biotech? Will it take you a lot of capital to get that initial product ready? And the thing with raising money from VCs is that you're not supposed to, raise all the money you need all at once. It's how much money do you need to hit your next milestones and advance to the next stage. So how much money do you need to go from Series A to Series B? That's what you should be thinking about. And again, there are a couple things like, what does your runway and burn rate look like? Best practices is to aim for 18 months of runway with each funding round. Make sure you put a little bit of cushion in there because just standard is that you end up spending more money than you initially thought. Or say that you had to pivot a marketing strategy and that didn't work, so you have to try anything that costs more money. So making sure you have a bit of that cushion as well. And always be building those relationships. Always be building those relationships with investors, because fundraising takes time, it takes effort. It's not something that you can do overnight. Even once you have a term sheet, it can take anywhere from at least 6 weeks plus to get the money in the bank. So always be fundraising, and that's just a quick note. So okay, how are we doing on time?
Still have 5 minutes, Arooj. Please continue.
Okay, great. So I just want to leave you guys with a couple of resources. So I have a book that's coming out. It's called The Pitch Deck Playbook. It's coming out this November. And just want to leave you guys with this. If you email me with a couple of sentences on what you learned from this talk and a bit of feedback, I'm going to go ahead and send you a free copy of my book. This is limited to the first 10 people that email me. I love feedback. I love hearing what you guys got out of it, what was really high value to you. So I'd love to hear from you. Next, I'm also doing office hours. So I'm reserving 90 minutes of a time slot for office hours. So 15 minutes each for 6 people. You can ask me anything related to my presentation. I know I covered a lot of content. I don't think I left a lot of time for Q&A. So this is just a chance for you to ask me any questions that you had. So yeah, that just about sums it up.
That was a wonderful session, Arooj. Is this offer of free book valid for us
Absolutely.
as well? So we do have a couple of questions, Arooj, but we are running short of time. So I'll communicate those answers to you personally, and then you can answer me back.
Sounds good.
And because we have to rush to another session, sir, your concluding remarks, please, and your questions if you may have any.
Well, without exaggerating, I would say this was one of the best. I think it actually justifies the closing ceremony of closing stage of our this 1 month's roller coaster. Actually, it was the final stage was even a roller coaster in itself. Because the way she wanted to bring in everything on almost anything she has brought in. It's just now that somebody, if had an idea, he can now reach up to a stage where he can actually get money and start doing business. I mean, this is what I got out of this, and I think this was. We will definitely pursue this with our audience and our students, because they would take a little bit time to absorb it. We will try to explain it to them so that, and you will realize this once you get more and more questions from Pakistan, that we've done your job even further. And I'm sure we need your permission that we will be trying to propagate whatever you said in this 1 hour further to our people and increase the audience. Because this thing was really sort of not, I would not call it an overview. It was the crux of it. The whole 1 month's job you have done it.
A whole session on itself, which again is why I'm writing a book on this. And so definitely a little bit more in depth.
No, Arooj, yeah. As I said, without exaggeration, it was a condensed form of everything what we actually told them to do. But here was somebody talking who is already a success story. So the story telling was very, very not only emphatic, but very, I think, result oriented. At least from my point of view and my perspective. But then I would not say that because I have been teaching this also, so I can understand. But we will try to make it as easy as possible for our audience, and you will realize this, as I said, in your feedback. So thank you very much once again. It was wonderful, and I'm sure if we have a plenty of questions, we will try to make them into one sort of a session. And I'm sure we'll find some more time you to come on board at a later stage.
Thank you for having me.
Thank you very much.
Sir, humble submission that this is not the end. This is the beginning of InnoMafia. This is not the end. You just said that we are concluding the program. So we're not concluding the program. We are starting the era of InnoMafia.
I think Arooj might not be very familiar with this. The mafia itself is a word which is a third world countries, people from first world call them mafias. And we call some mafias within the country itself, like the cartels of sugar and wheat and all that stuff. So mafia comes from there. It is a very negative word, but we are using it for innovation mafia, or mafia to be short, so that we can actually spread out this entrepreneurship and innovation into almost the blood of everybody in Pakistan, so that they become mafias. Get hold of a venture capitalist like you.
Fingers crossed.
Thank you so very much, Arooj. It was a wonderful session. Like John Saab said, like you just nailed it. You just nailed it.
I covered a lot.
Yeah, and like I said in the beginning, that since you know perspective from both sides of the table, so it was wonderful. It was wonderful. Thank you very much for being with us, and we'll surely keep you engaged again in the future as well.
Sounds good. Thank you.
Thank you so much. We are signing out, and we'll be back with after a short break with the second session of the day, guys. Thank you. Allah Hafiz.